Welcome, everyone. I'm Angelo Robles to the Angelo Robles Podcast, where I look to distill the best practices and best ideas of the world's most successful investors, families, and family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of successful investing families and family offices. Today's session is titled Growth and Evolution of Digital Assets as a New Asset Class. Now, many of you know I've been certainly very bullish, probably more so as a store of value on cryptocurrencies, specifically Bitcoin. And we've had some amazing guests on and many more to follow. But we actually have done nothing on that. It really is much deeper than that. And I don't just mean the blockchain, but that's going to play into it. But tokenization and how it's potentially changing how investors invest alternative assets, perhaps both from the selling and buying side. And we are early in this. I mean, this is probably top of the first inning, where maybe you could argue Bitcoin and crypto is bottom of the first. So it's really, really an interesting time in this community. And we have a great guest on today, and that would be Jeff Dorman, who's the CIO of Arca. Let me tell you a little bit about Jeff. And I've known Jeff for a number of years, and it's a pleasure to reconnect with him. As mentioned, Jeff is the CIO, that's Chief Investment Officer of Arca. In his role, Jeff leads the investment committee and is responsible for portfolio sizing and risk management. Jeff has over 17 years of trading and asset management experience at firms including Merrill Lynch and Citadel Securities, where he oversaw trading for over 100 million in proprietary capital. Jeff also served as COO of a fintech company where he built a social platform that is widely utilized by asset managers and investors. He's a CFA and holds a bachelor's in finance and economics from Washington University in St. Louis. Jeff, it is so great to reconnect again. It's been too long.
It has been. Happy to be here, Angelo. Thanks for having me.
Well, I've always enjoyed our interaction, and which is probably several times going back 4 or 5 years ago. And if you remember, boy, it was one of my favorite events. It was really, really small. It was in the winter, and that was the charm. It was in Vermont. Mm-hmm. And, what a great setting, which included a little bit of programming and a lot of drinking, a lot of food, and a lot of skiing and snowboarding. I know that sounds like fun. Unfortunately, that wonderful place, I'm forgetting the name. I think it might have went bankrupt and maybe is in new ownership now, but that was a lot of fun. Oh, yes, Jeff, it makes me yearn a little bit for the days of physical events. The good news is they'll eventually come back, and relatively sooner than later. But digital, pardon the pun, in the transition to what we're talking about, has its advantages as well. As I noted, we've been pretty deep in covering Bitcoin, and more so to come in the future, and it may indirectly weave its way into our conversation today. But I'd like to talk a little bit more broadly about how investors, accredited, qualified purchasers could be more active looking at it as an asset class, and what would it replace, and how do you do that, and what is tokenization? So we have so much to discover. If I had to lob my first question at you, as I said, there's been a lot of focus on Bitcoin, but there is much more to that family offices should be thinking about if you want to look at this as an asset class.
Absolutely, and we're going to get back to the small Vermont, country club that went bankrupt, because tokenization could actually have probably staved that off. So we'll get back to that in a second after we kind of build some building blocks here first. To start with, just about everybody enters the blockchain space to begin with through Bitcoin, right? Bitcoin is the first thing you've heard of. Bitcoin is what people associate with. And that's good and bad, right? It's good because Bitcoin is easy to understand in terms of what it is. It is a form of money. It is a form of asset transfer. It's bad in the sense that because Bitcoin has gotten so big in terms of the media narrative, that everyone has now lumped cryptocurrency in with being the entire space. And the reality is, this space is much more than just money. It's much more than just Bitcoin. Really, what we see is there's 4 types of digital assets right now. There's cryptocurrency, which includes Bitcoin and a few others. But then there's also 3 others that most people have never heard of, or at least have not focused on. And the first one being what we call protocols and platforms. This, you may have heard of Ethereum, you may have heard of Tezos, maybe some others. But protocols and platforms are basic building blocks similar to like what the internet was, right? So for anyone who has any sort of technology background, what HTTP is or what TCP/IP is or SMTP for emails. These are the protocols that everything was built upon. Websites were built upon it. Email was built upon it. That's basically what these protocols and platforms are. And by using a token, you can decentralize the build out of this process and ultimately incentivize through financial gains the computers and networking power that keeps us up and running. We don't actually do a lot of investing at Arca in this protocol and platform bucket. It's largely what venture capital investors are investing in because it's very boom or bust. There's going to be a couple of really big winners that kind of like, again, are the building blocks of something huge, and there's going to be a lot of losers. So it's a much more binary venture capital bet. Where we spend a lot of our time is in the other two buckets of digital assets. One is asset-backed tokens. And this is exactly what it sounds like. These are tokens that are backed by equity, backed by debt, backed by income streams, backed by hard assets. And I'll give you an example of these because it really hits home into why this new tokenization of asset-backed forms can be so innovative. There's an NBA player by the name of Spencer Dinwiddie who plays for the Brooklyn Nets. He has a 3-year, $12 million a year contract that's very backloaded. He doesn't get most of that until years 2 and year 3. So obviously anybody who's ever done present value math, he is incentivized to sell that forward and get that money up front. But what he's doing is he's tokenizing that income stream by issuing tokens at a 5% coupon to investors who not only want to get that hard income in the form of a 5% coupon, but also it's layering on some social benefits as well. The ability to possibly go to the All-Star game with him if he's selected, the ability to sit courtside with him at games. So what he's doing is he's tokenizing a hard asset, an income stream, but using the flexibility of blockchain to issue these instruments to investors and also layering on additional utility features to the people who buy this in the form of some sort of, like I said, social contract. And there's plenty of other asset-backed tokens. We're in talks right now with a music company that is trying to tokenize the royalty streams of music, right? So they go out and buy a catalog of music, and we can go out that we fund that with a token, and that token is going to serve as the instrument with which to get those royalties. So you can see where this is headed, right? Anything in the world that has a hard asset or some sort of income stream, you can tokenize that and sell that now to investors. And the key being there's no bank or brokerage account involved. This is a direct to consumer. You own the token and you can trade this peer-to-peer however you want. The fourth category that is what we call pass-through tokens. Pass-through tokens are the most unique, the most interesting, the best investments in our opinion, but also the least understood. So when I say pass-through token, what I really mean is the token represents a hybrid value. Call it a quasi-equity, quasi-utility type value. And what you're doing when you own a token is the company or the project is passing through some form of revenue or profit or dividend or some sort of mechanism to you. So I'll give you an example here as well. Binance is the largest exchange right now in Asia that allows you to trade digital assets. You can trade Bitcoin, Ethereum, and thousands of other tokens that you may or may not have heard of. They came up with the idea of a BNB token. And the token gives you, like I said, that hybrid qualities. On the one hand, it's a security in the sense that you are getting 30% of the revenue and profit of Binance is being kicked back to Binance token holders. So that's the pass-through component. But as a utility, if you own this BNB token, you get discounts on their platform. You get trading discounts, you get rewards, you get access to new deals that they bring. So what are we really doing here, right? What we're doing is we're combining your customers with your equity holders. Instead of having Amazon shareholders get all of the profits of Amazon and Amazon Prime holders getting all the benefits of Amazon, you're now combining them into one person. Your customer becomes the equity holder. And as a result, this is why you're seeing the fastest growth we've ever seen in businesses in blockchain, because you are turning your customers into your equity holders and thus into evangelists of your business. And you're seeing insane growth in these businesses because of that mutual alignment. So I'll pause there because that's a lot, but that's what we're looking at. That's what's so exciting about blockchain is that we are basically creating a new part of the capital structure, right? You have equity is a claim on cash flows. You have debt, which is a claim on assets. And now you have tokens, which is basically a claim on future growth, a claim on network growth. And when you put that together, it opens up the door to investable opportunities that have never been there before.
It sounds interesting. There's a lot I don't quite understand. So I'm going to ask you questions from a really foundational perspective. A little bit of a sidebar. About a year ago, Spencer Dinwiddie's manager effectively reached out to me. And I didn't really have as much knowledge or interest in Bitcoin and crypto back then, but I am a big sports fan. And of course, I knew who he was. He's in the New York area on the Nets. But I was fascinated by how forward-thinking him and his manager and team are, and how they were looking to even effectively create a small family office, which is one of the reasons why they reached out. So just a interesting sidebar. Let me wrap my arms around it a little more. So you mentioned the protocol and platforms. If you don't mind, in my example, could I use a piece of real estate? Would that be okay?
Well, go ahead. Yeah. I mean, I don't think that would be a protocol or platform, but let's hear you out and see where you're headed with this.
I mean, I was basically going to say, imagine there was a piece of commercial real estate. It was 50 million, as opposed to getting one specific buyer to purchase it. Could that be available to, and I don't know, do you have to be a accredited investor? But let's assume someone could invest a minimum of $1,000. So it has many, many people that would own a token that is produced by that hard asset. So in the example you give, it's an asset-backed token. So to me, it needs to be like a royalty, a contract, like with Dinwiddie in music. I'm going to say real estate, but you'll correct me. So it's backed by something. Is the token that produced, is it effectively its own specific cryptocurrency, or it has nothing to do with that? How does that intertwine?
Yeah. So when I use the word cryptocurrency, I think of money. Right. The reality is any of these blockchain-based tokens, the whole idea of what blockchain does is blockchain makes any asset transferable. So let's back up for a second. What did the internet do? The internet made forms of communication faster, cheaper, global, right? You could send 100 pages in an email in a second to Japan, right? Anything that was a form of communication, the video chat that we're having right now, right? All forms of communication, the internet allowed you to transfer free and globally very easily. What blockchain is doing is the same thing for assets. Now that you can send assets in digital form without having to worry about double spend, this is true for Bitcoin as well as all the things I'm talking about, you can now send any asset freely anywhere. So what does that mean? What it really means is you don't need a bank and you don't need a brokerage account in order to send assets anymore. You don't need that middleman. So to your point, what do you do? Any asset that has previously had to go through some sort of legal process or some sort of brokerage middleman process, you can now divvy that up. Like you just said, you can divvy up commercial real estate. You could actually take the Mona Lisa, right? Like how would the Mona Lisa be sold in theory today? It would have to go to a Sotheby's auction and one person or a syndicate of people would take that down.
And extremely expensive fees. Do I need to be in the US to do something like that, a accredited investor?
You don't as an investor. The issue on the regulatory front is from the issuing side. So us as investors, you can pretty much invest in whatever you want. The problem is the issuing companies and projects who are choosing to issue a token, they are being restricted from the US right now because there's a lack of regulatory clarity. So, for instance, Arca is has a hedge fund structure, which is a British Virgin Islands structure. We can invest in whatever we want and anybody can issue a token to us. If you are a US citizen as an individual, you might not have access to a certain deal, not because you physically can't buy it, but because they won't sell it to you.
If you don't mind, Jeff, I'm going to interrupt you quite a bit. If I'm a very, very wealthy, a single family office, I have an LLC or a C Corp structure. Could that structure do that in the same way that Arca could, or would I likely need to set it up offshore?
You would likely have to set it up offshore for somebody to sell it to you, but you, in terms of buying it, would have no issues. Meaning, the whole point that I'm getting at here is because this trades peer to peer. If say Arca owned it as a British Virgin Islands entity, but you wanted to buy it, we could sell it to you. There's no restriction in terms of you being able to buy it. The restriction is the issuing company themselves is not able to market it to the US simply because there is no clarity yet in terms of how this can be done. Now, to be fair, a lot of companies are now starting to go through the registration process. It's expensive and it takes a long time, but there are a few examples of companies who have issued tokens in a fully registered manner, and those are available to anyone in the US as well as abroad.
Excellent. That is helpful. Let's go back to, and again, I didn't know it was going to go in this direction, but I mentioned one of the last times I physically saw you, probably 2016 or so, was the intimate event I hosted at that beautiful resort location during the winter in Vermont. And unfortunately, it looks like, unless I'm wrong or something happened positively, it didn't make it. And you mentioned, tokenization might have been a strategy that could have worked for that ownership group. And I gave a real estate example before, but if you don't mind, if you could use that, don't mention the name of the location, but how could that have been of value?
So when you think about what debt and equity are doing, right? When you raise debt or equity, you are effectively just capitalizing your business, right? There's no other utility or benefit you get from that. If I go out there and I raise equity, I'm finding some people with deep pockets who are going to give me money and they're going to share in the upside of the property. If I raise debt, similarly, I'm capitalizing the business and I owe them a coupon, but there's no other externalities. What tokenization is doing is, again, it is turning your customers and your users into your quasi-equity holders and therefore turning them into evangelists. So if that small property who obviously ran out of money when times got tough and didn't have enough membership, they could have pre-sold all these memberships in the form of a token and given people the liquidity of that token to trade themselves and potentially have them share in the upside of this property. Now, obviously, this concept itself is not new. There's all kinds of different ways to share in upside and to share in profits. What's new is the ability to quickly bring this to market in the form of a token, issue it directly to somebody without a brokerage or a bank account, and ultimately let them share it with themselves peer-to-peer, right? It's very difficult for me to transfer my equity in a private company to another individual without having to go through some sort of secondary market to do it. The idea here is that because of the blockchain, because the blockchain is just an accounting ledger that's public and transparent, you can do these transactions peer-to-peer without ever having to get a middleman involved. So had this small property that we were talking about, they have a membership, they can pre-sell these memberships to their customers in form of tokens. They can ultimately give their members a reason to become evangelists, because as the mutual grows or as the profits grow, they would get kicked back financially. You might see them be able to grow members much faster, and you'd also see them be able to stay in business financially without having to go out there and raise additional debt and equity. So in my opinion, right now, most of the companies that are issuing tokens are digital asset native companies. It's mostly infrastructure, right? It's the equivalent of the 1990s internet, where if you wanted to get exposure to the internet in the early days, you had to buy things like Netscape and things that were building on the internet. Nowadays, if you want exposure to the internet, you have all the companies building on top of the internet. You have Amazon, you have Shopify, you have eBay, et cetera. We're still in the early stages of digital assets, where most of the tokens that we can buy are this infrastructure. But in the next couple of years, it will be the private chalet in the Northeast that is trying to build memberships. It will be Netflix. It will be local restaurants. They will be using tokenization to fund their businesses, even help turn their customers into evangelists, bootstrap their growth, and give these customers a way to transfer these assets in a peer-to-peer fashion.
Okay, Jeff, I'm going to bring this incredibly close to home, and I had no idea it was going to turn in this direction. So this is exciting, very unscripted. But when I mentioned the Vermont, which was a membership, or effectively a membership club, and like 2 and 2 came to my head. I'm a membership organization. So bring it really close to me. I'm effectively a solo entrepreneur. I've been doing this a long time. Yeah, COVID changed things, or I needed to adapt. But basically, a lot of my foundation is, let's say, membership. Let's give a rough number for a family, about $5,000 a year. What could I do? So historically, I could raise debt. I could create a deck and sell part of my company to whatever, a minority investor. That would take a little bit of time, a little bit of money. I'm probably small, so not an investment banker, probably a business broker, probably a circle of friends, et cetera. I mean, you know the drill.
Mm-hmm.
Am I too small for what you describe? Or in theory, could an organization like mine much more perhaps effectively and efficiently, how could this work for me? Imagine you were an advisor and had a couple of minutes to really break it down. What would you tell me?
Yeah, so first of all, you could create a limited number of tokens and say that, 50% of the tokens that I created, I'm going to give to my members, and the other 50% I'm going to keep for myself so that I can run my own business and make money. These tokens will go to everyone who's a paying member. We'll have some percentage of these tokens set aside for new members. And as new members come in, every single existing member will get, some sort of a kickback for, a percentage of the profits that you're generating from that. And as a result, the members that you already have will be incentivized financially as well as through utility to help grow the organization. And if any of your members decide they want to leave, instead of having to cancel with you, they could just sell their tokens to someone else, and they eventually take ownership of that membership. So the idea here is these are almost like fixed income instruments more than equity instruments. And the fact that you're probably already spinning in your head, there's an infinite numbers of combinations that you can come up with to make this work. Just like there's infinite coupons and maturities and callability, putability, convertibility structures. That's the same thing with tokens. Each one of these can be structured in a unique way to fit the business needs, but you can effectively come up with a structure here that gives you still the ability to make profit and run your business and ultimately live a life that you want to live, while also encouraging your members to help you grow the business and also increase the utility of what they're getting, because the more members and the more solid people that come to your organization, the more utilities they're getting from networking and other events that you're doing. So it's all about aligning incentives.
And as someone who would be the creator or issuer in this example, myself, would I need to follow certain regulatory documentation protocol? Are there legal people that specialize? I'm assuming the answer is yes in this. And is it still considered a securities offering?
Sure. So one of the questions I saw in the chat was asking, like, where would these tokens trade and how are they valued? So to answer your first question, you could do this totally in a private way without ever registering it or ever listing it anywhere. And you would just say, members, here's your token. And if you guys want to trade it amongst yourselves, I'll create a chat group with you guys and you guys can talk to each other and trade it back and forth amongst yourselves as you please. Alternatively, you could have this listed on an exchange like a Coinbase or a Binance or somebody that specializes in the trading of tokens. And therefore it opens it up to the world where more people could have access to these tokens than just your private members.
What would they want to see from me to get on that platform?
What would who want to see? Somebody who is looking to buy those tokens?
Well, I mean, why would they choose me? Do I have to fit certain criteria to be on that platform?
Yeah, if you were, chances are you'd have to pay for the listing, or you'd have to prove to them that there would be enough trading volume for it to be worthwhile. Now, there's also this is going really deep in the weeds. There are also decentralized places that trade this, where there is no ownership group. It's just a decentralized piece of technology where you could literally list your FOA token, and it could trade immediately without any market makers, without any listing fee or anything, and this could be available right away. It's called Uniswap. Uniswap is a place where you can trade just about any token that's been ever created. So yeah, you could create your token, you could list it on Uniswap, and the only thing you would need would be a developer who understands blockchain and could actually build the token for you. And to your point, yes, there are lawyers and there are companies out there who do just this, who structure tokens.
So people that would structure the token, what am I looking at? Like 5,000 or like 500,000 cost?
Definitely on the lower end. If you're just looking for someone to build the token and that's it, I don't know the exact cost there, but it's not much.
Me being a membership organization, I issue tokens to members. I'm still able to have an annual dues for them being a member.
Correct.
So the value for me is people that become a member, pay, have a token, and they have the option of selling that token. That still is kind of an equity stake in what I do.
Yeah, exactly. You're basically giving a quasi equity stake to your members. The difference is it's not an explicit equity agreement where you have a prospectus and you have a legally binding notion. So there is a definitely, that's why I use the Amazon Prime example so many times. Is that think about Amazon Prime. When I assume you and everyone else is an Amazon Prime member.
Of course.
Most of us, when we signed up for Amazon Prime, what did we think we were getting? We thought we were getting free shipping, right? That's literally why we signed up for it. And now, what do you get as an Amazon Prime member? You still get free shipping, but they've added on movies, music, Whole Foods discounts. They have, this was not what you signed up for. They have added increased utility to it over time. this is where the nature of tokens is so interesting. It's not as legally binding as debt or equity in the sense that you're locking into something right off the bat and you know exactly what you own, but you're basically taking a bet on management or whoever issued the token that they're going to accrue value to you over time in other ways. So when you introduce your FOA token, it might be, hey, pay $5,000 a year for this token, and you're going to get access to our events. Over time, there might be 4 or 5 additional add-ons that you get for being a token holder. So there is definitely a leap of faith element in the same way that when you back a venture, when you make a venture capitalist investment in a startup, you're certainly taking a leap of faith that they're going to stick with what they said and they're going to build it the way they said. But at the same time, because of the nature of the way these tokens operate, it is so flexible from a capital formation standpoint and from a bootstrapping network standpoint that if you align incentives correctly between issuer and token holder, you can create this dynamic where both grow together. And that's really where we are in the cycle right now. That's where we are. These tokens are, like I said, they're hybrid utility, they're hybrid equity. They're not legally binding yet because there has been no court precedent. But in my opinion, it is a part of a company's capital structure. It is a way to basically pre-sell revenue and to add utility to your members and to align your members or your customers with your underlying business.
Could a token holder be diluted in terms of I create more tokens?
So it depends on how you structure it off the bat. So you can structure it open-ended where there's inflation. You could structure it where you're going to create 1 million tokens and that there's never going to be more than 1 million, and I'm going to issue all of the 1 million tokens right away. You could say I'm going to issue 1 million tokens, but I'm only going to sell 500,000 of them, and I'm going to keep 500,000 back to issue later. You could have an inflation schedule. You could even have an amortization schedule. You could say I'm going to issue 1 million tokens, but every year I'm going to take 10% of my profits and buy back with free cash flow any outstanding tokens so that I increase the value per token. So this is why I always use the fixed income analogy. This is much more akin to how bonds work than how equities work, right? And the fact that you can structure these things in any way, shape, or form to meet the needs of yourself. Now, the creative part of it is that because all of these tokens that are in existence are so new and so different, and because they're flexible, it's really, again, it's a game of incentive alignments, right? You as the issuer need to figure out how to align yourself with your customers to make everybody happy. If there was $100 on the table, there would be a lot of arguments between the parties of who should get $10, who gets $15, who gets $5, right? I mean, the idea of equitable splits, that's effectively what tokens are doing. They're taking value and they're figuring out what is the right way to divvy up that value among my stakeholders meaning management, customers, et cetera, and ultimately providing a way for this asset to be fully fungible so that people can trade in and out of it as they please.
And the value of the token, is it as simple to say if your revenues are XYZ and they double, the token's worth double, or is it a little more complicated than that?
So it depends, right? I mean, again, this is where the uniqueness comes. There are some tokens that pretty much stay at $1 per token forever, and they are not meant to appreciate or depreciate in value, but you get a dividend in the form of new tokens whenever there's cash flows. There are other tokens where the price of the token goes up as there's demand and growth in the service. I'll give you an example. We own a token right now called Uniswap, or the one I was telling you about. Uniswap is an exchange that allows anybody to create a token and let people trade it. We own the underlying token of Uniswap. So what does this token do? This token right now, every time something is traded on the Uniswap platform, there's a 30 basis point fee. So it is a cash flow generating company that earns 30 basis points per trade on all the volume that they're doing. And this company is doing billions of dollars of volume. They're annualizing $400 million a year of revenue. Right now, all of that revenue goes to the liquidity providers, the market makers that are on that platform. But there's a proposal right now to take 1/6 of that revenue and give it to token holders. So you can do the math right now. If it's a $400 million revenue and 1/6 of that is going to start going to token holders, right? So, call it $70 million a year. Well, what would you be willing to pay for a token if you're getting $70 million a year of interest? You just start doing regular securities math. You start looking at dividend yield. You start looking at present value of cash flows, and the price of the token fluctuates as people start to evaluate what the actual cash flows of the business are. So these tokens can be fixed income. They, like I said, they could be like a stable token where they don't move in price, but you earn a dividend. It can be a growth token that moves up and down as the revenues of the business move. There's all kinds of different tokens, but the point is, we've been talking now for half an hour, and this has nothing to do with Bitcoin. That's the takeaway, right? This is not Bitcoin. This is not money. This is not decentralized currency. This is a form of capital formation by companies and projects that can be analyzed using traditional financial metrics. And that's what we do. And the exciting part from an investing standpoint, and why so many investors are now looking to us as a form of alternative investment, is that not only is there real value to be had here, not only is there real growth, but most people have never even heard of this. They don't even know this world exists, right? And if you think back to like the 80s and 90s and early 2000s of why hedge funds did so well, it was because they were investing in structures that had high growth potential, but very low competition. And that's where we sit today, is this entire universe of tokens is being built and issued. And there's only a handful of funds like Arca that has the knowledge base and the wherewithal to invest in this right now. So it's really exciting times. I didn't mean to deviate from your FOA token. We can.
Oh, no, that was great. Really, and, what would be like, is there anything iconic that I would know that decided to do a token? I don't know, like the Chrysler building or the Mona Lisa. What are you starting to see that's becoming like, this is something that they could have went in a different direction, but they took tokenization?
Yeah, so that's a great question, and truthfully, like, we haven't seen that Fortune 500 company yet, or that big, well-known company yet issue a token. It's coming, but it hasn't happened yet for a variety of reasons, right? One is the regulatory clarity we already talked about. Two is that there's no investment bankers in this space yet, so there's nobody pitching companies. But they're going to come. What we're seeing right now, for the most part, is small, kind of medium-sized companies that are doing this. So I'll give you an example. There's a company in Europe called Socios, SOCIOS. They have figured out that clubs, soccer clubs, football clubs, cricket clubs, that they're struggling for revenue. So they came up with an idea called a fan token. So they're helping to underwrite on behalf of Juventus, Real Madrid, FC Barcelona. They're issuing tokens from these companies, from these teams, to their fans. And if you own one of these fan tokens, you get the rights to vote on what uniforms the team wears, what music they listen to in the locker room, who's going to start during an exhibition game, things like that, right? It's giving the fans a little more control and ownership over their favorite team. Well, they issued these tokens, and each team now has their own tokens, and there is an exchange that Socios owns that basically allows you to trade these tokens back and forth. So if all of a sudden, Juventus, all of a sudden they get Lionel Messi, the Juventus token is going to go up in price, because all of a sudden there's more demand for that Juventus token. Similarly, if FC Barcelona, maybe all of a sudden they sign a deal with a 17-year-old kid that's going to be the next player for the next 15 years, that token's going to go up in price. So what you're seeing here is like, no, that's not a household name. No one's ever heard of Socios, but certainly FC Barcelona and Juventus are household names. And you're starting to see them utilize tokens to engage their fan bases. So I think you'll start to see more and more of this over time. Basically, like I said, any business that has a membership model or a customer model can utilize this technology. It's just not quite there yet where it's in the mainstream.
There's a question that came in. Where do you get the information to determine a token's value?
Right. So there's two types of value in the world, right? There's intrinsic value, means what is it actually worth without any third-party validation. And then there's trading levels, right? What is the actual executable price? So the intrinsic value question is very different depending on the instrument. Like I said, if it's a cash flow producing instrument, you can run a yield, or you can run some sort of a model to figure out what it's worth from an intrinsic value, from a cash flow standpoint. If it's not something like that, you definitely need third-party validation. It has to trade on some sort of an exchange where people agree on price. And that's why, if you've ever gone on to, for anyone listening here, you can go on a site called CoinMarketCap, COIN Market Cap. It lists thousands of tokens, and you can see the observable price. And these prices are determined by people trading on various exchanges. So, like stocks, like bonds, there is an observable price that people actually transact, and that's what it's worth according to the market. Now, we don't have, for anybody who's been big in equity or debt investing over the last, however many years, that there's agreed upon formulas for how debt and equity are valued, right? You have Frank Fabozzi's Fixed Income Bible, which is 1,500 pages, which talks about duration and present value and bond math. You have Graham and Dodd, right? The book from the 1940s talking about equity valuations and how you should value equities. There is no agreed upon valuation in this space yet. It is being worked on by firms like Arca and others, but there's no agreed upon valuation. So the prices are very volatile right now because they move up and down on speculation. They move up and down on information asymmetry. But there is an observable price. There is a price that you can get in and out of a lot of these tokens. And like I said, going back to your FOA example, when you first issue it, there will be no observable price. But as you issue it to hundreds of members and you put it on something like Uniswap where people can trade it, an observable price will start to develop. And it's no different than, if you can go back to just this year when Spotify and Slack when they listed their equities, they didn't do an IPO, right? They didn't have Goldman Sachs or Morgan Stanley underwrite an IPO at a certain price. They did a direct listing. Well, how does a direct listing start to trade? Eventually, buyers and sellers come in and you meet that equilibrium, and that's how the price is determined. And that's the same thing that's happening with tokens.
I'm going to try to see how I could articulate my next question. It's, I could see to the intermediaries, let's broadly go with the verbiage banks, that this could be a little scary. It's so early. It may not even be the top of the first inning. It may be batting practice.
Yep.
So everyone's concerned about short term. So it's just not really on the radar yet. But as this inevitably starts to get more traction, how powerful could they be, whether it's lobbying or governmental involvement, to have them make sure that they get a piece of the action, or simply make it burdensome regulatory wise?
You're talking about the government or banks or who? Who do you think is the bottleneck here?
Both.
Okay, so I'm not a real big believer in disruption. I'm a big believer in technological change. Meaning, let's go back to the robo-advisors, right? When Betterment and Wealthfront came about, a lot of people were like, oh, that's it. Financial advisors are dead. Here comes technology. And what happened 5 years later is every single financial advisor just built their own robo-advisor, and now they compete with Wealthfront and Betterment. I think the same thing will happen here, right? At first, the banks will view this as, we're in trouble. And eventually they'll be like, okay, we can get in on this. We can start trading it. We can start underwriting it. We can start banking it. So I think the banks will get in on this just like they do everything else. The government is a different question, right? The government in general is not trying to stifle innovation. They just take a lot longer than other people want them to, right? It's not unreasonable for the SEC to take 5 years to come to an opinion on this, given that it's brand new and it's changing every minute of every day. So I think the regulators will be very friendly over time. They just need to figure out what this is first and figure out what the right protections are. In the meantime, we are in this wild, wild west environment, right? Where, retail investor Joe Smith might be getting run over once in a while because he doesn't know the same information that Arca knows. And in that regard, you want regulation to happen faster so that retail investors don't lose their shirts. On the other end, that's the opportunity from an investing set, is that we have information and valuation techniques and the ability to analyze these instruments where others don't. And that's why we're able to create, in cases like this year, multiple 100% returns in our fund, because this is brand new and there's just a limited playing field looking at it.
There's a question that came in, relates a little bit to my real estate example from earlier. Given the liquidity crisis around the corner, do you expect to see more real estate tokenization? And then as a follow-up, she states, also might be instructive to touch base on the St. Regis Aspen deal.
Sure. So start backwards for a second. For those who don't know, there was a property, I believe it was in Colorado, called the St. Regis, that tokenized ownership of the hotel. It was like a $40 million property, and they tokenized the shares of that hotel, right? It was a straight equity deal. Just instead of issuing shares that trade DTC or in private fashion, they issued tokens to represent those shares. It was an interesting deal. It didn't have a lot of demand, and here's why. There's a massive chicken and egg problem in the market right now. Most of the digital assets that exist today, from Bitcoin down to Ethereum, down to the ones that I've been talking about that you've never heard of, they are incredibly volatile. And what does volatility tend to attract? It tends to attract gamblers, right? People who want to say, I put $1,000 into something and 2 days later I have $2,000. That's why digital assets trade so much right now, is there is this get rich quick idea from a lot of retail investors that they think they can make a lot of money really fast. No different than the people who trade Tesla or Beyond Meats or any other stock that has high volatility. But on the other hand, you have things like a hotel that is going to offer probably a more stable, 8 to 25% annualized return. The problem right now is the people who understand how to own and trade tokens are not the same people who want to own an 8 to 20% boring property in Colorado. You haven't figured, like, that Venn diagram hasn't connected yet, right? The people who want fixed income, stable returns are not in the tokenized world yet. And the people who are in the tokenized world want nothing to do with a tokenized hotel. Eventually, what's going to happen here is somebody big and important is going to come to market, and everybody is going to enter the token space, whether they like it or not. So for instance, let's say Amazon Prime said, you know what? From now on, your Amazon Prime membership is a token, and the only way you get the benefits of Amazon is if you own a token. Well, guess what's going to happen? Every single Amazon Prime member is going to spend the next month trying to figure out what a token is and how do I buy it, and then they're going to get into this market. And once they're in the market, then when you see a St. Regis deal, be like, oh, well, I already know what a token is. Oh, look at this interesting St. Regis deal. I can earn 20% yields by owning it. I'm going to buy some of that. So until we match the product offering set with the investor base, there's going to be some of these dislocations, but they're coming. And the more people who get into the space, the more of these opportunities are going to be shown to them.
And Jeff, how does Arca differentiate their strategy from some of the other managers in the space?
Great question. Thank you for teeing that up. There was really three types of investors in this industry when we started our firm 3 years ago. There were your Bitcoin only investors who were essentially software developers and technologists, or even like libertarians and anarchists who just like, they wanted a different form of money. That's all. They didn't care about anything else other than that Bitcoin seemed like a good store of value or a good gold replacement, and I want to buy it. The second type of investor that came in pretty early were your quantitative and algorithmic traders, because they saw that tokens were really volatile. They were highly correlated. There was a lot of quantitative tools that determined how they were trading. And these algo and quant funds just started trading stuff around whether it had value or not. The third type of investor was your venture capital firms, right? These were the people we talked about earlier who are backing that are backing like the long shot bets, right? The future technology of the world, these Ethereum protocols, these basically like internet type building blocks. What there wasn't was what Arca does, which is combine traditional financial analysis and fundamental research with the new volatility and capital structure components of these tokens. So what Arca does is we created a special situations fund where we do real fundamental research. We look at cash flow analysis, we look at yields, we look at relative value, we look at trading relationships. We're basically combining all three of those. We have knowledge of Bitcoin, we know how to trade and have capital markets experience, and we also know how to do deep dive research into the future like the venture capital firms are doing. So effectively, we've created a fund that is basically investing in early stage technology, but capitalizing on the inefficiencies of a liquid market.
And a little bit of a different direction, does passive or index investing make sense in an asset class as inefficient and as volatile as this one?
So there are a few passive indices that exist. There's something called the Bitwise. Bitwise is a company that has a couple of different passive index products. There's Galaxy, a company created by Mike Novogratz, right? Galaxy has an index. Here's why I would say indexes don't work in this space right now. If I were to create a technology stock index and I didn't include Facebook and Amazon and Google and all of the FANGs, you'd be like, well, that's not very representative of the technology industry. That's effectively the problem in this space, is that it is evolving and growing so quickly that the tokens that exist in these indices don't represent anything close to what is actually happening in the market right now. So, if you just want exposure to Bitcoin, you can go buy Bitcoin. If you want exposure to the actual asset class, you pretty much have to go the active route right now, because the indices are not giving you what you want yet. Now, in the future, there will be indexes that actually make sense. But it is unrealistic to think that a passive strategy right now is going to take advantage of all the nuances that I've been talking about for the last 45 minutes.
Do you think we're headed to an environment where everything could be tokenized?
Here's my vision of the future. Everything has evolved because of the internet, except for money. Money is still the only analog thing in the world relative to what else is going on in society. It is really hard right now, and it's really hard to have any fungibility of your assets, right? Your cash is very fungible, right? You can take your cash and do anything you want. But your Tesla stock or your Facebook stock or your ownership of a private equity fund, That's pretty rigid. You have to basically go back to the place you started to get any money out that you can use anywhere. My vision of the future is that every asset you own, from your mortgage to, or your house ownership, to your stocks, to your bonds, to your digital assets, to, pretty much anything, your baseball cards, everything you own is going to have a digital representation, and that representation is going to be held on your phone, not in a bank or a brokerage account. And when you make a payment, you're going to have a choice of, I'm going to take out pro rata a piece of every part of my assets. And if you think about where we're headed in the world right now, with tens and tens of trillions of dollars of debt at every country, and massive debt to GDP ratios, not to mention all the money printing, the governments around the world are basically daring you to own cash. They're saying, do not own cash. It is worthless. It is going down through inflation. Do not own it. Put it to work somewhere. The problem is you can't do that in practice, because when you start to buy things that have yield and have value, you get stuck in them for 4 or 5 years and can't get out of it. Well, that's really what blockchain and tokenization is solving for, is you're going to be able to have 100% of your money in assets that you want to own, but those assets are going to be fungible and tradable, and you're not going to have to go through a bank or a brokerage account or a 3-day settlement process to get that out. So yes, I think everything will be tokenized in the near future.
Going to have to make you an honorary libertarian with that answer. And yeah, I mean, that was a very quick, summary of the challenges that governments are having with, again, deficits and inflation likely to skyrocket, coupled with something that's so antiquated, like how we quote unquote handle money. Once you have analog and you have digital, once something is digital, it doesn't really go back. And for a variety of reasons, governments, the establishment, banks have been, they're probably worried about what that could look like. Obviously, governments are already exploring creating their own digital currency. I think that might have some advantages, disadvantages, but it's inevitable, whether I would maybe like it or not. What you're describing, is it 2 or 3 years in the future or closer to 20?
That's a hard question. I think digital currency itself, like government-backed currency in forms of money, are probably 3 years in the future. I think the other world I'm describing is probably more 5 to 10, where every asset that you own, from your jewelry to your baseball cards to your car collection, has some sort of tokenized ownership, and you can actually sell pieces of that whenever you want. I think that's more like 10 years away. But what is being built today is the infrastructure that allows for all of that to happen. And that is the types of things that we're investing in Arca right now. Is we are investing in the infrastructure that is allowing these things to happen, so that 5 to 10 years from now, when you are interacting with blockchain, you don't even know that you're doing it, right? When you send an email, you have no idea what's happening, right? Very few people actually know what happens when you hit send on your email. Well, the people who are investing in email clients and Google and Yahoo and things like that, they knew, right? Those were the early stage investors who understood what was happening. That's where we are today, is that these infrastructure and pipes are being built, and investors like Arca are taking advantage of it, so that 5 to 10 years from now, anybody can use these products and not even know they're using them.
And back a little bit to what Arca is doing, and broadly talking about the community, from cryptocurrency to blockchain to tokenization. Again, not every person wants the exposure directly through a cryptocurrency. So what you're talking about, and Arca is one of the more significant players. And again, it's like perhaps not even in the first inning yet. So it's very, very early. How could, and I'll put this more at qualified purchasers, single family offices, how could they get more active? And I guess another question is going to put you on the spot. If they're going to put capital to it, I don't know, 1%, 3%, 5%, where are they taking it from? What's going to be missing out now?
So I'll work backwards. I'm not a wealth manager. I don't do anything with regard to asset allocation. In general, those who do make asset allocation decisions, they're doing it based on what they think the risk and reward is, right? So if we as an industry in digital assets, if we can help articulate what the risk is and what the reward is, then individual investors and families can make an assessment on their own what percentage of their net worth they want to put into it, right? I've heard people write about 1 to 3% of your net worth should be in Bitcoin. I don't have a good answer to that. What I can tell you is, this industry is maturing pretty quickly, and I personally run what I consider a sleep at night fund, right? This is not a fund that has binary outcomes where you're either going to get none of your money back or you're going to get a 6,000% return. We are running a fund strategy that looks and feels no different than a debt and equity strategy, where you should be comparing us to other alternative investments that have 30 to 50% yield type potential. Obviously, there's higher risk involved when you're generating those types of returns, but there is real potential here. And like I said, I mean, our fund this year is up several 100%. So I mean, the upside opportunity is there. So I don't know what the right allocation is. What I do know is you shouldn't, as an allocator to this asset class, you shouldn't be thinking right off the bat that you're going to understand everything about it, right? And I'll use a healthcare analogy. Most people have invested in healthcare in some way, shape, or form. But most people have no idea how hospital admission rates work, how Medicare reimbursement works, how phase 3 drug trials work, right? They're just saying healthcare is a sector that I want exposure to, and I'm going to find a way to get exposure to it, either via an active manager or an ETF. I think that's where we are in digital assets right now, is you're not going to get all the answers overnight. It's taken me, multiple years to understand this space. But if you start to slowly recognize that this is not going away, that it is the technology of the future, and that there are real investable opportunities, then you go out there and you do your due diligence the same way you always do, and you find a manager like Arca or someone else that you trust to help shepherd you into this new asset class. And what we're doing with our LPs is we're forming partnerships with them. A lot of LPs are giving us money as much to educate themselves as they are to actually grow their wealth, because they know that we're going to help teach them and show them deals and show them the same things we're talking about right now. We're doing that on a regular basis with our LPs to help them understand what else is out there. So I personally believe, and I'm putting my own money and my own time and my own career into it, I personally believe that everybody should have an allocation here and take it out of some other pocket of their alternative investments.
And there is a final question that came in from a participant. It's more of going to be a Bitcoin and crypto question. Let me ask it because it interests me as well. Federal Reserve already is building architecture for a digital currency in a year or two. Then he comments, giving them much stronger control of the money. Mm-hmm. Yeah, it's a great, efficient vehicle for checking on money laundering. It will be probably wonderful from a tax perspective. Mm-hmm. I would look at it maybe as a little bit of Big Brother, but my greater question on top of that, so we're going to kind of layer it a little bit, is will that crush Bitcoin and other cryptocurrencies?
Sure. So the first part of it is everything you said is 100% true. Think of even the stimulus checks that just went out, right? If you have a Bank of America or a Chase account, it was really easy for you to get your stimulus account or your stimulus check. But what if you didn't have a bank account, or you needed the money but you didn't have the same means? Having a blockchain-based wallet and being able to distribute dollars in that form would have been instantaneous and easier to get to people and easier to track, like you said, than going through the traditional banking system. The FBI has even explicitly said they hope criminals use blockchain more because it's so easy to track. That's the whole point of this. So yes, it's Big Brother-ish, but at the same time, it is way more efficient. Now, whether or not, so that's inevitable. That's happening no matter what. What the question is then, does that crush Bitcoin? I think it can definitely crush Bitcoin in developing in economies that are developed where you trust your governments, right? Like, whether you're a libertarian or not, like there is an element of trust of the U.S. government that they're not going to just steal your money and walk into your house and take your assets. In other countries, that's not the case, right? In other countries, people are very scared of government. So the idea of a non-government controlled currency like Bitcoin is not going to go away just because central banks and around the world get into this. In fact, it may even strengthen the case for Bitcoin because, again, once everybody understands how to use a blockchain-based wallet to hold assets, even if they came in because of the US dollar or because of the yen or because of some other currency, once they're in that ecosystem, they're probably eventually going to own Bitcoin too. So I don't think it kills the Bitcoin use case. I tend to think of it as, and this may show my age as a 40-year-old father of 2 children, but when I first got my iPhone, I was not a gamer. I never played video games. But within 2 months of having an iPhone, Angry Birds ended up on my phone because it was there, right? It was in the ecosystem. I think that's the same thing with digital assets, right? Whatever gets people in the door, whether it's the US dollar, digital currency, or Bitcoin, once you're in the door, you're going to eventually branch out into other forms of digital assets. And that's how I think the super growth of this takes off.
Yeah, I mean, maybe a couple of comments on that, and happy to get your opinion on it. With Bitcoin, and I guess most other cryptocurrencies, it's a finite number. With Bitcoin, it's 21 million. If the government does it, they're going to treat it like they did money. They could, well, not print, they could create more. So I would still be very interested in Bitcoin, and things could turn bad pretty quick. We saw with COVID and civil unrest here. It could have been a lot worse, I get it, but it was a little scary there for a while, and probably still is. And people would have a little bit of, I'm not so sure. And that's going to make me feel more comfortable in Bitcoin. Now, we didn't get into, besides my comment that they could create more, and that's why I think Bitcoin would still be very valuable. Mm-hmm. And I'm forgetting a little bit of my train of thought, but that was the main one. It was the fact that, but they're not going to limit it to a specific number, as they need to add to our deficit more. They could keep on creating and creating, and that's going to dilute the value. Oh, I suppose technically they could outlaw it, but I'm going to hope we don't come to that. And that still doesn't guarantee that people aren't going to use it.
Well, look, I mean, every single currency in history has died after about 80 to 100 years, right? And the U.S. dollar off of the gold standard has only been around for about 70 right now. So we're teetering on the edge of historically where every currency collapses anyway. So, I mean, look, I personally believe that currencies are all doomed. I think it's a race to the bottom of who can devalue the fastest, and it's just going to be inflation everywhere. But don't forget, like, all currencies is trust and purchasing power. That's all a currency is, right? If you trust that it's worth what it says it's worth, and you have,
it's not backed by anything.
Yeah, I mean, Bitcoin,
faith and credit.
Every single day that Bitcoin exists and it doesn't die is another day towards strengthening that trust and that purchasing power. So I don't think anything's going to kill Bitcoin at this point. It's been 11 years in running. Now, whether or not Bitcoin becomes a great investment or not is another story. But I don't think Bitcoin's going away.
And any chance Bitcoin will be part of the SDR?
I'm not familiar with the SDR. What is?
Andrea, who asked the question, if you want to elaborate a little bit in the chat feature, she's typing something in now. Special drawing rights.
I would love to defer that to another panelist that you have one day, because I'm not familiar with what that is or what the Bitcoin story is with that. But I'm going to Google it as soon as we're over here, because I don't know.
As I'm sure many people are. Well, this was fantastic, Jeff. For those that have an interest in learning more about Arca, how could they learn more about the organization, contact info, and maybe right before you give that, I would like to know that, again, things could change. Right now, we're recording this in mid-November of 2020. Sometimes these recordings are rather evergreen. You may hear it in a day, a week, a month, a year, or 10 years, and things could change. Tax regulation in general. Also, looking at it as an investment, you probably should be someone who's an experienced alternative investor, probably a minimum, in my opinion, at least, of a qualified purchaser. My focus is what I do is more on, the highest level, a single family office. But even then, you need to do your own diligence. Everyone has different time horizons, different goals, etc. So this is meant to be educational. It's meant to be even a little bit, hopefully, entertaining and engaging. But at the end of the day, anything relative to investing, you need to be very careful and do your own diligence. Okay, Jeff, now you could go.
That's great. Yeah, well, I mean, look, thanks for having me. I love talking about this space. I really believe in it. Our website is ar.ca. Anyone who wants to speak directly about our investments or our fund products, they can reach us at ir@ar.ca. We also have a weekly blog that is designed specifically for institutional investors and family offices that help people understand this space. And they can register for that, again, at our website, ar.ca.
Perfect. Thank you so much, Jeff. And kind of one of my usual closes. Everyone, I'm Angelo Robles, the host of the Angelo Robles Podcast and founder and CEO at Family Office Association, a global membership organization dedicated to families of great wealth. We're doing a significant amount of original proprietary content, and actually still shortly going to continue doing some very, very small in-person workshops. But a lot of our transition during COVID is doing hundreds of online digital. So we've been incredibly active. Take a look at our new websites, familyofficeassociation.com. We're very active on social media. We're Family Office, so very simple on YouTube. That's where we have a tremendous amount of content, which is, of course, on a social media platform for free. But our members get special access, opportunity, and much more lively in the moment resources that are really exclusive to them. So, and maybe one day I'll consider tokenization, maybe sooner rather than later. This was great to have the discussion today with Jeff. Jeff, thank you so much for your time.
Thanks for having me.
My pleasure. Bye.